In this video, we're going to talk about interest rates. And we're just going to start with a very simple structure. How are interest rates created? And not so much created, but what is their composition? So let's take a look here. So what things affect interest rates in general? Now, production opportunities. The more opportunities there are, the greater demand there is on money, which means there could be greater interest rates. Time preferences for consumption. People would rather have money today than money in the future. So as your preferences for consumption increase, that means you're going to want more money today. That means interest rates today should increase. Risk is a factor. The riskier something is, investors, consumers in general want to be compensated for that. So as risk increases, interest rates will also increase because of a greater desired rate of return. And certainly inflation is important. That as expected inflation goes up, people understand that they need more return just to get to a zero purchasing power change. So they would expect interest rates to increase. So let's kind of talk a little bit about how these things work, right? So, and the term interest rate applies to debt instruments primarily. It's a form of compensation paid to the borrower, but it's also the return to the lender. So the term required return is usually applied to equity instruments, but it's the same basic concept. It is the cost of gathering money, whether you are borrowing money, and we call it interest, or you are issuing securities like stock, and we're going to call it a return. The basic fundamentals are, as we mentioned earlier, inflation with rising prices in products and goods. We see changes in interest. Risk, again, the risk comes from several different factors. We'll talk about some of those in this video. But as risk increases, again, we want to be compensated more. And interest rates and returns will go up. And liquidity preference, right? This basically talks about the general tendency for investors to get money sooner rather than later. So the first part of the compensation of interest rate is something called real rate. And without getting in a lot of technical economic details, right? This is just the intersection, if you will, of supply and demand of money. Now, in the economy, we have our typical positive slope for supply, negative slope for demand. And as economic conditions change, the tastes and preferences of borrowers, lenders, their preferences, as those things change, interest rates change. In this case, it's the real rate. So the real rate of return is essentially the intersection of the supply and demand of money in our market. Now, the nominal interest rate is the actual interest rate charged by the supplier of funds and paid by the demander. Now, this nominal rate differs from the real rate. Why does it differ? Why is it different? Well, because there are other parts of the equation, right? So there are inflationary expectations. In addition, there are risk characteristics, both of the issuer and of the issue itself. So this nominal rate, the actual rate that we're paying, right, the stated rate here, It has two basic components. It has a risk-free rate and it has a risk premium. So let's look at our formulas here, right? So here we have the real rate, the rate of return R sub 1 here is the real rate plus inflation. Now we can refer to that as the risk-free rate. The risk-free rate is the real rate plus inflation. Now we also need to look at the risk premiums that may or may not be in a particular investment. So what are those risk premiums? The typical ones we talk about are default risk, the chance that the issuer will not pay, liquidity premium. This has to do with the ability to sell. How quickly can you sell that? And then maturity risk premium. This identifies time. The longer the time frame, if you remember, investors want to get paid quicker. If we go farther out, we're going to have to pay higher returns because investors want to be compensated for the risk of us not paying and the time delay itself. So what kinds of things are affected of these? So if you think about it, a short-term Treasury security is influenced by the inflation premium, but it doesn't have any of these other risk premiums. Primarily think what? Default risk. It's a United States Treasury security. It is by definition risk-free. Liquidity premium. Treasury securities are basically cash. You can use them actually as cash. And as far as maturity risk, since they're so short term, they don't have maturity risk. A long-term security, inflation affects it obviously, but it also has maturity risk premium because some of these could be as long as 30 years. Now, if you think about short-term corporate and long-term corporate, the differences between the two is in the other ratios, right? It's in the default risk and the liquidity premium, right? So these factors affect corporate securities, but do not affect United States securities. So one of the things we can do is to try to address and look at what we understand as interest rates. What do we actually see in the marketplace? So the term structure of interest rates is the relationship between maturity and returns in real time. So this it's a table that basically shows us the rate of return if you were to buy a 30-year United States Treasury bond. What rate of return would you earn? Now, in addition to what you would earn, that also implies what the government pays, right? Because what you earn has to be paid by somebody. It's paid by the government. Now, we can also look at something called the yield curve. And the yield curve is just a graphic representation of the term structure. And essentially what we're looking here is the yield to maturity. We'll talk about this later when we talk about bonds, etc., in some later videos. But this is just the rate of return if you purchase an investment, a bond in this case, and you hold it to maturity. Now, this yield curve can have different shapes. It could be what's referred to as an upward sloping curve or a normal yield. This basically indicates that long-term interest rates are higher than short-term rates. Now, there are occasions, although very seldom, where we have a downward sloping yield curve, sometimes referred to as inverted. This basically is the opposite. It says short-term rates are higher than long-term rates. This usually is an indication of some type of economic upheaval, right? Recession, depressionary times could have inverted curves. Now, a flat curve basically says that it's very little difference between short-term, long-term securities. So let's see how these curves are created or how we can view them. So the first thing we need to understand is, how do you measure expected inflation for the future? Well, to measure expected inflation for the future, we need some forecasts. How they are forecasted, again, we can talk about this in later videos, but quite frankly, it's a little bit beyond the scope of this class. So let's just assume that we have predicted interest rates moving forward 5% next year, 6% in year 2, 8% year after. How you calculate expected inflation is the average of what you think is in the future. So here we have what? 5%. If you're looking for inflation over the next 10 years, it's 5% next year, 6% this year, and we said it's 8% every year after. So this is just the average, right? 5 plus 6 is 11. 8 plus 8 times 8, 64. So we have 74 oddly percent divided by 10 gives us this 7.5 odd percent. So again, it's just the average of the time frame. And of course, you need to understand that the exponent, the subscript here, tells you the year or the time. Now, as far as practicality, you have to earn at least this rate of return to break even with purchasing power. So if you have a 20-year investment, just to get to inflation, to beat inflation, you need to earn 7.75%. So what can you do with maturity risk premium? Well, we have a basic formula that's used in economics. And again, this is beyond this video, how we come up with this number. But in general, right, as time, investor preferences change, this factor could also change. But to find the risk premium, you take 0.1, multiply that by t minus 1. So t is the time element. So if it's 10 years, what is the maturity risk premium for a 10-year security? 0.1 times 10 minus 9. So it would be 0.1 times 9. That would be added in our formula. So let's see how this works. Maturity risk premium here, I had that's 0.9. 20 years, 20 minus 1, that's 1.9. This is a linear addition to the actual calculation of interest rate risk. So for our example here, how do we find out your expected or the risk-free rate for these time frames? The risk-free rate 1 year out is the real rate, 3% that we stated, plus 5%. There's no maturity risk premium, so it's 8%. What about 20 years? 3%. The real rate's always the same for everything on the same day. 7.75% is the inflation premium. 1.9%, in case we calculated that, is the maturity risk premium. So the risk-free rate for 20 years is 12.65%. Now we can incorporate this. This is how it comes out graphically. Here's the real rate. You add the inflation premium, add the maturity risk premium. This should be an upward sloping curve in a usual kind of economic environment. Now, what's the relationship between Treasury yields and corporate yields? Well, the difference is those risk premiums, right? So if we look at this graphically, right, they refer to this as the spread, by the way. It's just the difference between the curves. So if you were to take, here's the Treasury bond, a double A rated bond has a higher rates of return over time. And if you look, the difference here is what's referred to as the spread. So if you could buy a United States Treasury bond, let's go down here at 20 years, you'd get 7.4%. 9.2% is what you'd get for the AA rated bond. The difference between them is 1.8%. That is the spread. Why the difference? The difference is because of risk. Hope you liked the video. Talk to you soon.